If you've had an outperformance so far this year, it's because it's full of crap. Literally everything that's rallied this year, I've put the dash for trash, or the British expression, which I obviously can't use on the presentation, is the flight to shit. So when you actually look at the things that have massively outperformed so far this year, expensive software, stocks that absolutely everybody else hated, so the professional investor market thought these were rubbish, non-profitable companies, or meme YOLO stocks. So if you don't know what they are, ask your children or grandchildren, but they will be just things that they found on the internet and they thought it was a really good idea to invest in them. What's generally not done so well is actually safe, boring stuff. And this all seems very, very odd, doesn't it? That why should this junk be sort of rallying? Well, actually, it's very consistent with history, because we have a model. We have a model, and it's not just mine, it's been observed over time, that you get this strange pattern in investment markets. So you get this move from institutional investors, so that's professional investors. Suddenly, your meme stocks, or it's in the paper, you should have all these investments in your portfolio. Then it starts going up, it goes up more, then we get a peak. Then you get this short downturn movement, and then a bounce, what they call the return to normal. Sometimes on academic literature, they call it an echo bubble. So oddly enough, when you look at all that stuff on the previous thing, all the stuff that had done well previously is now doing well again, which is very much consistent with an echo bubble. Then potentially the market rolls over. So just remember that general shape. As everybody that's been here before, you'll know that my esteemed young colleagues, impaired as they are by their youth, like to make fun of the fact that there's usually some nautical reference in there. So we are expecting rough seas. Yeah, so we're expecting, as I said last time, there's going to be a bit of bouncing around in the market. So what have we done? We've reduced the risk exposure on both the equity and the bond side of your portfolios. The equity portfolios, for the reason that I showed with that discounted cash flow, we've moved again much more to highly cash generative companies, because the value of that cash that comes out of the company is worth a lot more than it used to be. These are generally called value companies or value stocks. Our fixed income portfolio remains very short term because we expect rates to carry on with upward pressure. And again, we're taking very limited credit exposure. We've also had a dollar bias in the portfolio that you've known for a while. You still have time to sell, don't worry. Thank you very much. We've also still got a dollar bias in there, which I'll go through, and we're offering, obviously, a couple of new products. So most of you are aware of the short-duration bond portfolio. We've started to offer some venture capital. There's possibly a couple more that you'll see this year. So we've kind of de-risked your portfolio a bit. We're remaining fairly defensive. The fixed income part of the world has actually sold off quite aggressively in the last 6 weeks. So that part is certainly performing, and that should ultimately, for the same reason that as bonds go up in terms of how much interest they have to pay to get people to buy them, that should reprice if you think about that cash flow calculation. So what does this mean for all you guys? So we've told you what we've done with the portfolio, but just to quote Mark Twain, there's a high probability that history will rhyme, as he points out. It might not exactly repeat itself. Just remember there are biases. So you are likely to see a lot more negative headlines if we are correct. Review your wider investments, particularly the stuff that's doing very well at the moment, because that's not normally for a good reason. We're waiting for the odds to basically move, because as you know, Rayliant, our parent company, is very much mathematically driven. The herd often does the wrong thing at the wrong time. And we see that again and again and again over history. So I could ask you all about who was the first set of investors on my original model for bubbles. And I'm sure you all remember it was smart money. So not even professional investors who have to take a lot of business risk, because it's very hard to outperform as a professional investor if all your peers are doing something slightly different, because amazingly you have very short windows as an institutional investor. But the people that can be patient, the people that can be smart, the ones that can actually accumulate things amongst all the problems are generally defined as the smart money. You don't want to be Joe Public. You hire us not to be Joe Public for you on your behalf. You want to be the smart money. And that's potentially where we'll be coming back and saying, look, I know it looks a bit scary. I know there's a lot of negative headlines, but we think now's the opportunity. The numbers are in our favour. The maths are in our favour.